Well, the S&P 500 really bombed in 2022, clocking a negative 19.4% return. That is an $8 trillion decline in value. Not as bad as 2008 when she fell more than 38%, but last year was the seventh worst year for the index in the last 100 years. Something I'm sure you felt in your account. Most advisors and even do-it-yourself investors use this index or a fund meant to track the index as a flagship holding in their models. Even Warren Buffett famously left last instructions that 90% of his wife's inheritance would be placed in a stock index fund. It is the essential benchmark for the U.S. stock market, composed of 500 U.S. companies across a variety of sectors and sizes. But it does have its flaws. You see, the composition of the index is based off of the market capitalization of the companies in it. Each company included in the index has a certain amount of outstanding shares at a certain share price. Those two multiplied together equal a company's market cap. And the larger the company and the higher the price, the greater the impact on the index. Apple, Microsoft, Amazon, Alphabet, which is Google, Tesla, and Facebook make up almost 20% of the S&P 500. Both Tesla and Facebook were down 65% last year, and despite all of those Amazon orders, they were down nearly 50%. It was a tech bloodbath. Last year was a banner year for investors to question the market cap index and toss out a new idea, an equal weight index. This 20-year-old strategy includes the exact same 500 companies, but equally weights their impact on the return, as opposed to a market cap index where mega cap or large companies have a larger impact. Proponents of equally weighted indexes really believe that you are overexposed to these mega cap companies and not as diversified as you should be. Critics of the equal weight index point out that more frequent trading has higher internal cost and that the increased exposure to smaller unknown companies increases volatility and risk. Historically, equally weighted indexes have outperformed the traditional S&P 500 index during bear markets like we had last year. However, looking at the last 10 to 15 years, the mega cap tech stocks and their explosive growth meant greater returns for the traditional market cap index. When evaluating the two, you have to consider your personal beliefs and expectations for the tech industry and really a few key stocks. Do you believe they are undervalued or overvalued? When the rally comes, do we expect the Teslas, Metas, and Amazons to lead the charge? Unfortunately, that is not something I can predict. However, it is worth having a conversation with your advisor and at least educating yourself on the difference. That's it for this week. This is Jeannie, the 401k lady.